Popeye's chicken sandwich is one of the greatest modern business phenomenons. After many failed attempts to pander to health-conscious consumers and to reposition into upscale dine-in eateries, fast food companies had thrown in the towel on the American market. In the United States, fast food only tends to get worse, and for years, McDonald's, Burger King, KFC, and other leading brands have given up on innovation and instead now lean on nostalgia and celebrities to breathe life into their stagnant menus. These brands have all deprioritized the United States in favor of international markets. The amount of McDonald's, Burger Kings, and KFCs in the US have been decreasing every year, whereas those numbers only increase overseas. Now that these chains have whittled down their food costs, they've shifted their focus to cutting labor costs through technology in front and behind the counter. Dollar menus have been eliminated, consistency has become just as rare as quality, and Americans have gotten used to getting the short end of the stick in fast food. While this has opened up opportunities for smaller competitors like Jollibee, Chick-fil-A, and Wendy's to take market share, the reality is that these upstarts still need another decade before they can reach a scale that will threaten the incumbents. All of these factors made the Popeyes chicken sandwich in 2019 a miracle in itself. In terms of quality and price, the sandwich was so unexpectedly exceptional that customers all over the country waited for hours just to taste the viral sensation for themselves. Popeyes had always been an anomaly in the world of fast food. It charges for sauces, its menu is relatively small, new products are infrequent, service is infamously poor, locations are sketchy, and yet the food is so good that people are always willing to put up with all of this. With the launch of the chicken sandwich, people who had never frequented Popeyes were suddenly compelled to visit, shops sold out every day, as the product miraculously lived up to the hype. The Popeyes chicken was so good that it appealed to all generations, and it put the Louisiana chain on the map as an equal rival to the long-fading, yet seemingly invincible KFC. The chicken sandwich was groundbreaking, not just in taste, but also in what it represented in an industry where standards in service and product had been plummeting for years. It was a reminder that even in a market as mature as fast food, that businesses compete on merit and that customers will always reward innovation and not just blindly follow brands, advertising, and past glories. As we covered in the Burger King episode last season and in the Under Armour episode this season, private equity can have disastrous consequences on businesses with their tendency to simplify everything into short-term numbers, tunnel vision on cost-cutting, and to peanut butter spread resources rather than create a coherent long-term vision. Yet the groundbreaking Popeyes chicken sandwich came from the same private equity owners that had been running Burger King into the ground. Was the chicken sandwich a rare example of where private equity works? What managerial lessons can we draw from Popeye's success? What made such innovation possible? And how is Popeyes doing today, nearly 5 years after the debut of the chicken sandwich? In this episode, we'll cover the rise of Popeyes and the present-day aftermath of this fast food miracle under private equity. Like most innovations, the chicken sandwich was the product of years of investment. To understand the circumstances in which Popeyes could have had the resources, environment, and inspiration to invent such a product, we have to go into the company's past. In corporate America, leaders are hired based on the following criteria: experience, optics, and domain expertise. Once you realize that experience is weighed over actual accomplishments, it really becomes no mystery why companies are so predictable in what they do, given how formulaic they are when it comes to choosing leaders. In every industry, the same pool of executives float around from company to company. Instead of being penalized for underperformance, executives, even those who are fired or have poor track records, are regularly showered with job opportunities. And with enough time, some of these executives naturally end up as CEOs on the sole basis of having the most experience in the room. These leaders tend to blindly follow the same strategies and make the same mistakes wherever they go because they're not incentivized to learn from their failures. The majority of these appointments typically do more bad than good, as these executives, who constantly fail upwards, tend to spend most of their time replicating how things were done at their previous company rather than actually leading their new companies. This is a common sight even in tech, where Amazon, Facebook, and Google executives regularly land CEO gigs at startup, and their tenures are typically brief and ineffective. In the past 2 seasons, we've seen several examples in fast food. In the Burger King episode, John Chidsey ran BK into the ground with his extreme discounting and also threw franchisees under the bus, yet years later is somehow deemed to be the right person to save Subway. In the KFC episode, The two executives who claimed publicly that they had rescued KFC in the United States leapfrogged their way into predictably short-lived, ineffective, and unsuccessful CEO gigs at Chili's and Carl's Jr. Popeyes in this respect is a rare exception. The CEO who brought Popeyes from a struggling niche chain to a respectable national rival was the same executive who had been fired by KFC in the 2000s for failing to grow sales at Kentucky Fried Chicken. Unlike typical executives who fail upwards, this leader had learned from her mistakes and became not just the savior of Popeyes, but also the mastermind who planted the seeds for the chicken sandwich even after her departure from the company. Under this woman's leadership, Popeye's stock surged from $11 to $80 by the time of her exit. Her name was Cheryl Bachelder, and she ran Popeyes for 10 years before the chicken chain was sold off to private equity. To put into context just how immature fast food was in the early 2000s, Taco Bell had just invented the cheesy gordita crunch and chicken quesadilla, popcorn chicken was KFC's most popular product, and multi-branding was the industry's hottest trend. Instead of putting all your chips into one brand, the winning move was to have a portfolio of fast food chains and then combine 2 or 3 of them under a single roof. Americans who grew up in the 2000s or earlier will likely remember the KFC Taco Bell or Taco Bell Pizza Hut combo stores from their childhood. The theory was that these multi-branded locations would gross higher sales than single-brand locations and be even more cost-efficient as both brands could share the kitchen, supplies, storefront, and rent. On paper, customers would enjoy superior levels of convenience, diversity, and optionality at multi-brand locations that single-brand chains like McDonald's would never be able to match. In practice, multi-brand locations actually increased operational complexity and consistently served worse food than standalone single-brand locations. In 2000, Cheryl was the CEO of KFC at Yum Brands. In her 3 years at the helm, KFC sales in the United States regressed, whereas every other brand in the Yum portfolio improved. As we covered before, international expansion was the focus for KFC. But in the early 2000s, that growth was just beginning, and overseas earnings were not yet robust enough where investors were willing to turn a blind eye to underperformance at home. Cheryl was fired in 2003, but the regression of KFC in the United States could be partially attributed to the changing consumer climate. Americans were suddenly health conscious, they preferred boneless over bone-in chicken, they were starting to get tired of the Colonel's 11 herbs and spices, and they had more options than ever before when it came to chicken. As Cheryl and her successors eventually learned, more advertising, rebranding, grilled chicken, and marginal food improvements would not stop the inevitable fall of KFC in the United States. While Cheryl was handed her pink slip, across the street, Popeyes was going through an even worse time. In the early 2000s, Popeyes was just one brand under another portfolio company by the name of AFC Enterprises. Yum Brands had become a multi-billion-dollar, multi-brand global powerhouse by assembling a portfolio of leading fast food chains, and AFC Enterprises desired to follow in those footsteps. But AFC Enterprises, with its smaller pockets, could only settle for second-tier and third-tier brands in Cinnabon, Seattle's Best, Church's Chicken, and Popeyes to complete its portfolio. But AFC Enterprises fell apart in less than a decade. Their accountant was Arthur Andersen, the same firm behind Enron and WorldCom. Arthur Andersen's fraudulent accounting had wormed its way into fast food, where the SEC discovered that AFC's income and margins had been overstated between 21% to 92% in the early 2000s. The stock was crushed, executives resigned, and AFC was tainted in the eyes of investors and operators alike. Even without the Arthur Andersen scandal, AFC had problems of its own. The portfolio strategy only works when you have category-leading brands. If your portfolio is made up exclusively of brands that are still in infancy or growth stages, you only end up spreading yourself too thin. AFC was confronted with the reality that they could either continue operating multiple brands with lackluster results or streamline and focus on making one single brand great. After 6 years of investment, AFC sold off Cinnabon at a loss. It had been much harder than expected to transform the single-product, venue-dependent cinnamon roll chain into a standalone, performant, multi-product, multi-channel bakery brand. Seattle's Best was sold off to Starbucks, and as we covered in the Starbucks episode this season, it became the foundation for Howard Schultz's CPG business. This left AFC with just 2 brands, Church's and Popeyes. Popeyes and Church's were both fried chicken chains and direct competitors, so one had to go for the other to succeed. But since Cinnabon and Seattle's Best both sold below expectations, AFC was forced to sell the better of the two chicken brands in order to maximize cash returns. And at the time, Church's was outperforming Popeyes, it had a clear positive trajectory, and it commanded higher book value with greater real estate holdings. But even with this singular focus, Popeyes continued to struggle through the 2000s. The chain unsuccessfully pushed a no-carb, non-breaded naked chicken, green beans, catfish, crawfish, popcorn chicken, and even a chicken sandwich as reactive measures to give people what they wanted in lower-calorie, boneless, toned-down fast food. Popeyes also held on to distinctive Cajun dishes like jambalaya, etouffee, fried livers, po' boys, and gumbo, which were still mystery foods to most Americans. Even as AFC rebranded into Popeyes, few executives wanted to join the next Titanic. The chain suffered from low awareness, choppy sales, had little presence outside of the South, and featured low profits. Popeyes burned through 4 CEOs in 7 years. By the time Cheryl took over in 2007, Popeyes stock had plummeted to $11. Rather than a year-by-year accounting of Cheryl's time at Popeyes, we'll break things down into what did and didn't go so well in her 10-year tenure as she transformed Popeyes from a struggling regional chain into a compelling nationwide rival to KFC. AFC's earlier multi-branding push had relegated Popeyes franchisees to the bottom of the totem pole as all the attention had gone towards the other brands, which were now no longer at the company. This neglect and the subsequent missteps deepened distrust between Popeyes and its franchisees. Decisions were made in a vacuum, and previous CEOs had pushed greater expenses onto franchisees, asking them to buy more equipment or to remodel their stores while sales dropped. In the words of a franchisee upon meeting Popeye's latest CEO, quote, "Miss Cheryl, don't expect us to trust you anytime soon. You gotta understand, we're like a bunch of abused children and you're the new foster parent. This has been all about you making money at the top end and us franchisees getting killed at the bottom end." Cheryl had learned from her time at KFC that there was no way to please everyone. Instead, growing the business, expanding, satisfying shareholders, and making customers happy only really worked if franchisees were successful. She set the company's focus on solely growing franchisee profitability and restoring their trust for the next decade. But Cheryl also learned from KFC that lip service and group therapy would only go so far, and she committed to the task year over year. Quote, "Simply put, we want to drive greater profits to the bottom line of our restaurant owners while maintaining the flavorful taste our guests love from Popeyes. Unit profitability is what our franchisees appreciate the most. These franchisees have a lot more invested in Popeyes than any of us do. These people have mortgaged their homes to be a Popeyes franchisee. The bottom line is how they pay bills and put their kids to college. We are fanatically focused on the profit and losses of our franchisees. We think that distinguishes us as a brand, and we've seen the strengthening of franchisee P&Ls in turn drives accelerated restaurant development." Cheryl assembled an ops team to aggressively pursue supply chain savings in purchasing and distribution every year. Since its founding, Popeyes franchisees had been given a long leash to run their locations however they wanted. This same laxness was present in bookkeeping, where corporate and franchisees operated independently of each other in the dark. Franchisees did not share their financials with corporate and vice versa, which created a vicious cycle of guesswork, poor decision-making, obscurity, and distrust on all sides. Under Cheryl, Popeyes began collecting income statements from franchisees every quarter in whatever format and channel it could. Some operators submitted them on pen and paper, some with Excel, or with printouts from their POS systems. Popeyes sanitized and standardized these raw inputs and then returned the aggregated results in the form of benchmarks. Franchisees could then compare their sales and costs line by line against other Popeyes in their town, region, or the greater country to identify areas of improvement, which was a level of transparency that not many fast food companies were doing in the 2000s. Cheryl's obsession with profitability can be seen in the improvements in franchised and company-owned restaurant operating margins through her tenure. The majority of Popeyes by the 2000s were franchised. At the few locations in which Popeyes directly owned and operated, restaurant-level operating margin improved from the teens to around 20% by the end of her tenure in 2016. The bottom-line improvement was even stronger for franchisees. The operating margin for a Popeyes franchise in the United States grew from 17% in 2008 to 23% by 2015. In comparison, the average operating margin for a KFC store was stuck in the mid-teens. Even if the average KFC was grossing higher sales, The average Popeyes franchisee was enjoying better profits. But Cheryl's laser focus on franchisee profitability was as much an economic decision as it was an emotional one. Lifting a page out of Yum Brand's playbook, she wanted Popeyes to get out of the fried chicken business and to become a pure franchisor just like the Colonel. The primary income in her mind should be a steady cash flow of franchise royalties, and Cheryl committed to that vision by selling off company restaurants to franchisees. This ensured Popeye's evolution to an asset-light business with low capital requirements. But bottom-line improvements would not be meaningful without growth in the top line. Before Cheryl, Popeye's franchisees contributed 3% of their sales to advertising. Yet this was all local advertising, and each region came up with whatever they thought would work best. This turned into chaos at scale, as every market came up with their own advertisements, so no two Popeyes commercials ever looked or sounded the same. Cheryl successfully pitched a new plan to Popeyes franchisees. Contribute 1% more, so now 4% of your sales will go to advertising, but in exchange, we'll roll up everyone's dollars into nationwide cable advertising where our unified messaging, positioning, and promotions will be far more effective in reach and conversions. And to prove to you franchisees that this will help everyone, we as a company will put in $6 million of our own cash to fund this initiative. Rather than diluting the sauce, Cheryl embraced Popeye's regional roots by putting its Louisiana heritage front and center. While this might seem obvious, anyone who has spent time in corporate America will know that common sense is not so common. Executives have a tendency to view markets exclusively through analyst reports and ad agency research, and consumers at the time based on those materials were trending against bone-in, greasy fried chicken. Cheryl redesigned Popeyes in logo and name, replacing the old chicken and biscuit taglines with the broader Louisiana kitchen. The purpose was to show that Popeyes was not only superior to KFC, but also completely different in spirit and taste from what Americans would be used to. Hand-battered chicken marinated for 12 hours every day at every restaurant, served alongside distinctly southern sides like red beans and rice, became the centerpiece of Popeyes' imagery. The product and quality had been there the entire time. The problem was just too few people knew about it. In a time where the fast food market was going broader, blander, and healthier, these opinionated and bolder refinements actually helped broaden appeal and sharpen Popeye's positioning as a unique chain where one could experience the strong flavors of the South. Cheryl's bet paid off as Americans exiting the Great Recession with greater disposable income flocked to Popeyes for an authentic taste of Louisiana. Cheryl's ruthless focus on franchisee profitability also sharpened Popeye's R&D muscle. In order to maintain trust with franchisees, she demanded new products go through rigorous due diligence to ensure they would not only sell, but also drive profits. This meant that the conventional practices in fast food of throwing darts on the wall, leaning into culinary trends, or rearranging existing ingredients would not be acceptable. Under Cheryl, every idea was scrutinized. It must have a strategic purpose, it must solve a clear problem, it must be scalable, it has to be linked to Louisiana, and it must fit with an established brand and culinary guidelines. Just like franchisee profitability, food innovation became a science at Popeyes. Quote, 4 times a year, we moderate a brainstorming session where everybody throws ideas on a screen. Amy, our head of culinary R&D, stops and says, okay, here's the 12 ideas I want to focus on. We then go to national research and we show customers these ideas on the menu and we ask them what their first choice, second choice, and third choice would be. We'll ask them how likely are you to buy this item at this price. And the threshold we try to meet is 30%. If we meet that 30% price purchase intent, then we go to the second phase. Typically, 12 out of every 75 ideas make it to the second phase. Our R&D chefs take these 12 ideas and then develop them into prototypes. It's not just the 4 chefs in our kitchen. Our outside vendors are also contributing ideas here, so now there's a competition on who gets to be the supplier of this new product. Then we do a central location test. People come in and we give them 2 to 3 products to taste and rank. The objective is to obtain a statistically reliable assessment of performance relative to our benchmarks. What percentage say, I definitely will buy this after tasting this? We get opportunities here to fine-tune the product for likability, or if it's too salty, too crispy, whatever. Now we're in the third phase. We started with literally hundreds of ideas, picked 75, tested down to 12, and now it's down to 4 ideas going into a test market. There are 3 things that must be greenlit before we take the product nationwide in sales results, consumer insights, and operations. Did the new product drive guest checks and a certain threshold of sales? Did people see the advertising? Did it drive them to the store? If they tried the product, did they like it? Did those customers like it as much as the people in the central location test? We compare scores to make sure the product served in the restaurant is the same as the product we tested. Then, can it be made at the volumes we're driving into the restaurants? All three of these have to be green. Once the product is settled, we turn it over to manufacturers, and the ways we're engineering chicken these days is frankly unimaginable. This should give you a sense of the chronology from idea to market for a Popeyes product. Cheryl, in her first year as CEO, had poached Amy from Arby's in 2007. It would ultimately be this R&D muscle and Amy, both of whom had been toughened up over years of trial and error, that would invent the groundbreaking chicken sandwich over a decade later. Under Cheryl's franchisor play, annual operating margins for Popeyes improved from low single digits and negatives in the 2000s to healthy double digits by the mid-2010s. Income from franchise royalties and overall revenue reached all-time highs, and global sales of Popeyes tripled to over $3 billion by the late 2010s at an annual growth rate of 9%. People couldn't get enough of Popeyes chicken, as global same-store sales as a measure of customer retention sat at positive 4% every year. The average domestic Popeyes went from grossing $980,000 a year in 2008 to over $1.3 million by 2015, which was heads and shoulders above KFC. While Popeyes' global sales was still 1/8 that of KFC, the unit economics of the Louisiana chain were truly industry-leading. Yet for all the good that Cheryl did for Popeyes, she was not without her flaws, and her tenure was marred with several key mistakes. In pursuit of franchisee profitability, Cheryl arguably did too much to keep operators happy. She regularly talked about the servant leader philosophy during her time at Popeyes, and that her job was to make others successful and to be the quote-unquote servant to franchisees. Rather than using the stick, Cheryl always used carrots, and was too soft with franchisees to the point of appeasement. As long as franchisees were making more money and reinvesting those profits by opening up even more locations, she regarded the universal customer complaints of long waits, understaffing, and rude cashiers at Popeyes as necessary evils. While every fast food chain has these problems, Popeyes is infamous for exceptionally poor service. Strangely, the continuous improvement in sales also demonstrated that Popeyes' product was so good that customers weren't deterred by bad service. But rather than enforcing service standards and driving franchisee accountability, Cheryl held off on raising this uncomfortable topic for as long as she could to avoid conflict with operators. It was only 8 years into her tenure in 2016 did Cheryl finally address the elephant in the room by rolling out store training, hiring hospitality-focused leaders, and conducting unannounced field inspections on franchisees. But at that point, the problem had festered, and bad service is a permanent part of the Popeyes experience even to this day under new ownership. But Cheryl's greatest misstep was scaling too slowly. The franchisor play had made the company entirely dependent on franchisees to fund expansion. The average Popeyes location in the United States grossed over $1.3 million in the 2010s, which meant that franchisees were taking home anywhere between $200,000 to $340,000 a year in profits per store. By extension, Cheryl had to keep Popeyes franchisees happy so that they would be incentivized to open up more restaurants. Existing franchisees were proven growth partners and significantly less risk than new applicants. With such strong unit economics, there was no shortage of interest from individuals in the US and overseas who saw the Louisiana chain as a slam dunk investment. Banks were generally not willing to finance the construction of a new Popeyes store, even to established franchisees, and so smaller lenders that were interested typically offered unfavorable, high interest, and secured personal loans, all of which slowed expansion. Popeyes lacked both the infrastructure and fearlessness to capitalize on the overwhelming franchisee interest, both domestic and overseas. Every new country was a risk, and Cheryl was hesitant to enter into mature markets that KFC was entrenched in, or emerging markets like the Philippines, where spicy, strong flavors on paper didn't entirely fit with local palates. Under Cheryl, Popeyes still grew but could not reach its full potential. Between 2007 and 2016, Popeyes had grown from 1,905 locations to 2,725 locations worldwide, at a pace of less than 100 net new stores every year. In the same time frame, KFC, even with weakening appeal, opened up over 4,000 new stores worldwide at a pace of nearly 500 restaurants every year. While it's unfair to compare Yum Brand's billion-dollar war chest to Popeye's penny jar, the harsh reality is that with franchising, you have to strike while the iron is hot. No one ever knows how long a brand will remain relevant, and once momentum is lost, few people will be interested in becoming franchisees. And without willing franchisees, expansion would be impossible. By the 2010s, Popeyes had hit a ceiling, and it was clear that the company needed a boost if it was to seriously challenge the kernel. The strong fundamentals of Popeyes caught the eyes of the Brazilian private equity firm 3G Capital. 3G Capital had followed the Yum Brands playbook, using deep pockets to fund acquisitions of category-leading brands like Burger King and Tim Hortons under a separate company called Restaurant Brands International, or RBI for short. Daniel Schwartz, who was the CEO of RBI who came from private equity, a person that we covered in depth in the Burger King episode last season, saw what we just analyzed. Popeyes was a resurging chain with a differentiated product that just needed to be in more places, and from a timing perspective, it had the perfect window of opportunity to scale. Interest rates were low, fried chicken was hot again, and the market didn't know what it hadn't tasted yet. RBI could provide this accelerant as they already had the global infrastructure, connections, and supply chains in place from Burger King. In 2017, RBI acquired Popeyes for $79 a share for a total of $1.8 billion and made no secret of their plans. Quote, "We're focused on trying to grow Popeyes faster in the US and even faster around the world. We believe there's lots of room for new Popeyes restaurants in the US where access to Popeyes is the number one barrier to visitation. About 65% of the US still hasn't tried Popeyes. The unit economics are compelling, and there's robust franchisee demand to build more. Chicken is popular across the world, and as we look at the size of some of our peers in markets like Brazil, Russia, and China, we see huge potential for growth for decades to come." While RBI let Popeyes continue operating independently, the new owners chose not to keep Cheryl. Within a year of acquisition, RBI had signed on partners to bring Popeyes to China, Spain, Brazil, South Africa, the Middle East, and Southeast Asia. And many of these partners were BK franchisees who were deeply familiar with RBI and interested in expanding beyond burgers in their home countries. Under RBI, the number of Popeyes worldwide have soared in 6 years, going from 2,725 restaurants in 2016 before its acquisition to 4,269 in present day. Unsurprisingly, the greatest growth has been overseas, where the number of international Popeyes has doubled from 658 to over 1,281. RBI also brought Popeyes to the digital age, with a mobile app, online ordering, delivery, and unified cash registers. The greater scale, both at home and overseas, has driven Popeyes to greater operating margins, franchise royalties, and profits. Beyond expansion and low-hanging operational fruit, RBI largely stayed out of the way. Product was Popeye's greatest strength and RBI's greatest weakness, as anyone who's been to a Tim Hortons or Burger King in the past 10 years can attest to. The R&D processes, Amy, and other culinary personnel from Cheryl's time were untouched and retained under the new ownership. There was no forced consolidation with Burger King or any other brand in RBI's portfolio. Since its founding, Popeye's bread and butter has been its signature bone-in chicken, which to this day still represents 2/3 of all sales around the world. At the same time, Popeyes has struggled to grow its boneless business for decades, as products like tenders and nuggets have historically only made up roughly 20% of sales mix. While bone-in chicken is more flavorful and more popular than boneless chicken, the profit margins are higher and the food costs are lower on boneless than bone-in. Tenders, strips, nuggets, and even quote-unquote boneless wings are made from processed chicken breasts, which is easier to produce, cheaper to source, and simpler to cook relative to bone-in chicken. As a result, the R&D focus on creating products to drive the boneless business stayed consistent under RBI. Since RBI was so focused on expansion, turning around Burger King, it had not been as deep in the fried chicken trenches like Cheryl had been for most of her career. Popeye's new owners didn't think too much of the chicken sandwich before its launch. To them, the chicken sandwich was just one of many experiments to drive the higher margin boneless business. Quote, "We're launching innovative boneless products like the recent addition of boneless wings to the core menu and experimenting with bold flavors to drive trial and frequency. Finally, we're excited about the potential launch of a chicken sandwich we've been testing in Texas. It's an all-white meat chicken breast fillet, hand-battered and hand-breasted with our signature seasonings. The test results are encouraging, and we believe it's the right product to close the menu gap. The overnight virality and sweeping success of the chicken sandwich at launch caught RBI so off guard that when the product sold out nationwide in its first week, the company needed 2 full months to build up enough supply to meet demand. The Popeyes chicken sandwich was a marvel. The thought, precision, and effort that went into every detail of the product, from the taste and thickness of the pickles to the softness and color of the brioche bun, was simply unprecedented. The patty was fried in a unique batter that was completely different from any of the conventional flour that Popeyes traditionally uses with its bone-in chicken. It was the first ever fast food product to look and taste as advertised. In an industry where new products are generally just rearrangements of existing ingredients with small tweaks like a new sauce or a new shape, the Popeyes chicken sandwich felt like it had been created by someone who really cared about giving you the best experience in every bite. In contrast, just months before, KFC had slapped on 2 chicken tenders and a handful of Cheetos between 2 buns and called it a day. The Popeyes chicken sandwich was extraordinary in that it broke boundaries in showing that fast food doesn't have to be a cheap afterthought or cash grab, but instead can be just as good and respectable as an independent restaurant. For the quality and volume of food given, the Popeyes sandwich felt too good to be true at just $4. The chicken sandwich was powerful in giving customers who had never visited Popeyes before a real reason to visit. But more importantly, the sandwich also drove ancillary spending, as customers came back to try different higher-priced items from the menu. Popeyes sales skyrocketed 18% in a single year, from $3.7 billion in 2018 before the chicken sandwich to $4.4 billion after in 2019. The continuous hype and rollout of the chicken sandwich to countries outside of the United States have kept up sales in following years. On a per-location basis, the average domestic Popeyes went from grossing between $1.2 and $1.4 million a year before the chicken sandwich to $1.5 to $1.8 million a year after. This growth continued through the pandemic, while the popularity of the chicken sandwich only strengthened franchisee interest and fueled expansion. Now, 4 years later, the excitement has died down as most customers have experienced the product for themselves, and the chicken sandwich is now commoditized. Nearly every American chain and independent restaurant these days carries a chicken sandwich on their menu. Without the prior investments in R&D, it took KFC, McDonald's, Wendy's, and Shake Shack each nearly 2 full years to build up that muscle to create and roll out comparable sandwiches of their own. And in between 2019 and 2021, Popeyes reigned supreme in the chicken sandwich wars. While the competition nowadays might not be as good as Popeyes for some, or perhaps better for others, customers have ultimately benefited from the collective improvement in standards and greater emphasis on quality across the industry. While there's been no drastic drop-off, there are some worrying signs ahead for Popeyes. From 2021 onwards, sales have slowed even as Popeyes has reached record pace and expansion. With over 600 new restaurants in 2 years, half of which are international, where American fast food brands are generally well received, one would expect stronger growth. When we look at Popeyes' same-store sales in the United States, customer retention has been in the negative or single digits since 2019. If we examine closer, we actually find suspicious accounting, where Popeyes measures same-store sales using only locations that have been open for over 17 months. The industry standard when it comes to measuring same-store sales is usually with locations that have been open for 12 months. 17 months is an unusually high bar that allows RBI to manipulate numbers to its advantage through implicit survivorship bias. Any Popeyes that's open for 17 months and longer is most likely performant, and any Popeyes that's struggling will likely have shut down before the 1 year and 5-month mark. This means that the picture of customer retention that we're getting is not of the average Popeyes, and really of a smaller bucket of stable, maturing locations. Popeyes is starting to feel like it's heading down the same path of KFC and Burger King 2 decades ago, when management switched their focus to international markets, relentless expansion, cost-cutting, and efficiency. Anecdotally, I found the Popeyes chicken sandwich to be incredible the first few times I had it in 2019, but just a year later, things had already begun to change. The chicken patties became thinner, the buns got smaller, the sandwiches became greasier, and all the local Popeyes began cutting corners. Instead of making the sandwiches fresh to order like before, the stores began handing out lukewarm, soggy, stale, pre-made ones from steam drawers just because it was easier to do so. And it's not just speculation. RBI's latest strategy for Popeyes is called, quote, easy to love, with the goal of increasing average franchisee profitability to $300,000 by 2025. To achieve this, RBI wants to make Popeyes easier to run by simplifying cooking and streamlining kitchen equipment so franchisees and restaurants can earn more while doing less. Rather than making the fry batter by hand, RBI wants to automate that process away to save time and to add predictive software that tells workers exactly when and what to cook so customers can be served right away all the time. As we've seen with Burger King, KFC, and even Starbucks in the past 2 seasons, making something easier to produce never actually makes the product better. The other angle is China. RBI had long regarded the country as a frontier of untapped growth for Popeyes. Yet with deflation, a struggling economy, and the weakening RMB, China is not the same slam dunk or downhill ride for Popeyes that it was for KFC when the Colonel first entered the country decades ago. And just like with smartphones, innovation is impossible to sustain. Popeye's newest items are inevitably less exciting and are just small tweaks to existing products. Popeyes is ahead of KFC in terms of product, with its signature chicken sandwich and bone-in spicy chicken. But while we as customers would gladly welcome more innovation, it's worth remembering that KFC has reached $30 billion in sales on 28,000 locations worldwide with just its 11 herbs and spices. Every company gets a golden age, but given the track record of Popeye's current owners in the past decade alone, it's really a matter of when and not if the cost-cutting will begin. 3G Capital went on radical cost-cutting purges with Kraft Heinz, Tim Hortons, and Burger King, and while the numbers please investors, these brands are objectively serving far worse products these days than they were before their takeover. If there was ever a good time to cut back on quality, to reduce costs, and to go all out on an international expansion at the expense of the American market, this would be the right time to do so for Popeyes. While global franchisee interest is hot, domestic consumer sentiment continues to stay positive, and brand reputation remains intact, just like it was for Kentucky Fried Chicken 2 to 3 decades ago. It's said that history repeats itself, and what Popeyes does in the next 3 years will tell us if the chicken sandwich was truly the peak for this Louisiana chain, and if this is just another case of fried chicken déjà vu. At the very least, for those of us who got to experience the chicken sandwich when it first launched, it was a tasty but brief reminder of just how good fast food can be when companies focus on quality.